Hey, Doug, let's get to you because you were at the high end, too. You were looking for 800,000 jobs, roughly, and 6% unemployment. So you were right in that same range in terms of anticipating and expecting this. Rick brings up a good point, though. Is it going to be hard to continue to get workers to fill these jobs as this opening process rolls out across the country still?
Yeah, I think the most important thing is going to be the supply constraints. We know there's tons of demand stimulus out there, both from money sitting in savings accounts, the additional checks in December, the 1.9 trillion. You know, that's overdone it on the demand side. There's no question. The real issue is the supply constraints. The upfront ones are the virus. If successful in removing those from the headwinds, then you're going to deal with the policy that's basically saying we'll pay you to stay home. And those are issues that have to be dealt with.
Steve, you had a comment, something that you noticed in the numbers you want to bring up?
Yeah, a couple quick things. I'm looking for a number here, but the U6, the broader measure of labor slack in the economy, did tick down to 10.7%. That's the lowest we've had since the pandemic began. But where do we want to go? We want to get back to where we were. So that's in the 7% range. So really emblematic of what the panel's talking about. Good numbers, great numbers. We can argue whether or not unemployment benefits keep people from coming back in. They are coming back in. The participation rate did tick up to 61.5% from 61.4%. And I think it's also worthwhile to remember the revisions. We had a nice revision to the prior month. We're up near 500,000 for the prior month. So this thing has begun February, March. It's accelerating. And then we'll have to have a debate. Once we get people back to work about the policies out there from the Biden administration, are they good and they're bad? But the first order of business is putting people back to work. It's a good start. Long way to go.
Steve,
yeah,
what was
Austan,
the
numbers for
earnings?
February revised. Who asked that?
What was the average hourly earnings? What did we get? I didn't hear you.
Doug, was that you?
Down 1/10 on month over month, up 4.2 year over year. Down 1/10 month over month, up 4.2 year over year.
Okay, so Austan, let's just weigh in on the revisions, not only for February, but for January, too. You did see those numbers pushed higher as well. This has kind of been swelling up and really happening. It's been hard for us to kind of get a feel for what's happening because it's such drastic changes over weird periods of time. We haven't seen numbers like this.
Yeah, I agree with that. And, you know, they were probably going to keep getting these big revisions as they get the actual data and go back in these very uncertain times. I mean, I do think there's something funny or weird about us dwelling on people are being paid to stay home so they won't go to work when the very sectors where that's supposed to be happening are eye-poppingly big job-generating numbers. If you look at leisure and hospitality, we're at 240,000. You look at construction. So I don't think the American workforce is abiding by this rule book. You see people wanting to get back to work, and there's still a lot of people out of work. Now, they're not in the top part of the income distribution. Anybody could do their job from home. The jobs market is actually better than it was before COVID began. But if you look down at the lower income paying jobs where the jobs got to be done on location, they're still really suffering. And this is the first of the big numbers that hopefully we're going to have 6, 8, 10 months in a row of big numbers like this.
Yeah, Sarah, you alluded to that before. You anticipated that we see million jobs a month coming in the summer. But look, the strength of the numbers today, the idea that they could get revised higher like we just did for February and earlier, that just tells you there's something really moving quickly here.
What we need to get is the 4 million people who've left the workforce post the pandemic back to work. As schools reopen, as governments hire, we're optimistic that that can happen. Going forward, this continued powerful growth of leisure sectors should be what drives that number over the 1 million level. We like those companies that are very leveraged to services. So this is like Match Holdings and Match Group and Booking Holdings. These companies both very leveraged to the reopening. Match owns Tinder, OkCupid, Plenty of Fish. Total addressable market could grow 5 times over the next decade. And the pandemic was actually positive and negative for them. It did cut their growth rate in half, but going forward, people are now more comfortable with meeting people digitally and online. We're also big fans of the CEO of Match. She's one of the only women out of 31 who is a CEO of an S&P 500 company. Booking another company booked up 1 billion hotel rooms in 2019. As people go back to traveling, a lot of pent-up demand. We think Booking's very well positioned with an asset-light model, as they don't own these assets. They just earn commissions on them.
Shepard Smith here. Thanks for watching CNBC on YouTube.